Welcome. Let's talk about transfer pricing. Let's examine a situation in a company when a transfer price can lead to dysfunctional decision-making, and it can also lead to distorted performance evaluation of the two divisions in that company. After that, I'll show you how to calculate an improved transfer price that would lead to a fairer evaluation of the divisions and improved decision-making in the company. Let's imagine we have the XYZ electric scooter company. And this company has two divisions. We have division S and we have division M. These divisions are autonomous profit centers. That means the manager in each division is allowed to make their own decisions about sourcing materials, and these managers are assessed on their divisional profit. Division M makes electric motors, and these motors are sold to the outside world and also within the group to the scooter division. The scooter division then uses the motor that they've purchased from Division M in their final product, the electric scooter, and they also sell to the outside world. In our simple example, we have no limitation on production, so there's no problem about production of electric motors. We can produce as many as are needed by both internal and external customers. The motor division charges $45 to the outside world, and arbitrarily, they also charge $45 internally. So that is the transfer price, the internal charge between two divisions or business units right in the same group of companies. Now, let me give you some more information. The variable cost of producing the motor is $25. We'll ignore fixed costs for now. At this point, everything is fine in this organization until a new supplier emerges. This new supplier can sell generic electric motors of identical quality for $40. Ladies and gentlemen, now our conflict will emerge. Remember, the divisions have autonomy in terms of decision making, so they can choose their own suppliers. So if you were divisional manager S and you were judged on profit, you would probably go for the lowest cost inputs, assuming identical quality. So this manager would probably change suppliers and go with the $40 unit. But is that the best decision for the group? If we think about the group, what is the cost of producing a motor? $25. So from the group perspective, is it better to produce the motor in-house for $25 or purchase the motor for $40? Well, the $25 option is better, so the group should use the internal motor to maximize profits for the group. However, S is going to skip the internal sale and go with the $40. So that's the nature of the decision-making problem that you can see in a transfer pricing question on your upcoming ACCA PM exam. Let's now recommend an improved transfer price that could lead Divisional Manager S to say yes to the internal purchase and maximize profits for both divisions and for the group. Let's visit with our managers again. we have the motor division manager, the supplier, and we have the scooter division manager, the buyer. We have that new supplier who charges $40 per unit. Let's now think about the maximum and minimum prices that each manager would accept. Well, Manager M produces a motor for $25. So any price above $25, and Manager M would probably say, yes, I will accept that price. I'll either break even at 25 or I'll make a profit. The scooter divisional manager, they would have a maximum now. Anything over $40, and divisional manager S would say, no, I'm going to go with this guy. So any transfer price between 25 and 40 would lead both managers to potentially say yes. If we put the transfer price below 25, M would say no. If we put the transfer price above 40, S would say no. Let's imagine we recommend the transfer price to be $25, the basic minimum, okay? The $25. Mr. S would love that because Mr. S is saying, oh, look, my external price is 40. I could buy it internally from Mr. M, and I'm saving $15. So I'll have an increase in profit of $15 off of my external cost. Mr. M, on the other hand, is going to say, meh, I get nothing from that. That's my break even. So guys, then at the end of the year, at the divisional manager office party, Mr. S is awarded with Divisional Manager of the Year for the highest profit. Mr. M is now depressed because Mr. M made no profit at all. So 25 might not be the best transfer price. It might not be fair from M's division, and it will distort M's divisional profit. On the other hand, we could suggest a transfer price of $40. So that's the maximum that S would accept. Now, Mr. M would love that. Mr. M would say, oh, look at that. I'm now making a $15 profit on the sale, my or contribution, let's say. The variable cost is $25 to M, but they're selling for $40, so they're earning that extra $15. M is going to love that price, but S would then say, oh, that's not really fair. M is getting all the profits. I'm getting no advantage. At this point, do you see a potential transfer price that would lead both managers to say yes, and it would give both managers an equal boost to their profits? Well, I do. I think we could split the middle, right down the middle. And if we say the difference there was $15, 15 divided by 2 equals 750. So if we add 750 to that 25, we have $32.50 as a potential transfer price. If we then set the transfer price at that figure, divisional manager M would be happy, seeing a gain of 7.5. Divisional manager S would be happy, seeing a discount right off of the external price of $7.50, and they would both say yes. And now the group is happy because we are using the lowest cost input. Group profit is maximized. Guys, that's the nature of a transfer pricing problem that you might see in ACCA PM. Let's now move to a more complex example. We'll be a bit more precise with our terminology, and we'll look at this in the context more closely of the PM exam. Ladies and gentlemen, I've got an example from the Study Hub on my screen. Why don't you pause the video now, read this, give it a try on your own. You can also go into the Study Hub and try it on your own. After you've thought about it, after you've tried it, come back and we'll go through this together. Welcome back. Let's begin by looking at the requirements. We've got to calculate two things. Let's calculate a maximum price that Division F will be prepared to pay for 1 kilo of the chemical. And then we've got to calculate the minimum price that Division I will accept for the 1 kilo. Does that sound familiar? I hope it does. It's very similar to the situation we just looked at a moment ago. Then we've got to make a comment. Comment on the performance evaluation issues if the transfer price is set to $500 or $800. Finally, we're going to suggest an alternative transfer price or recommend an improved transfer price that would lead to a fairer evaluation of the performance of the two divisions. Let's jump in. I like to begin these problems with a sketch. I like to visualize it. So we've got an organization here, and we're looking at two divisions. We're looking at the I division and the F division. The resource in question now is a special chemical, and in our new situation, there's no external demand for the special chemical. It's only sold in the group, sold on to Division F. And we learn that the variable cost of producing 1 kilo is $500. We then learn that Division F further processes that chemical, and their further processing cost is $200. After which they sell their final product to the external world for $1,000 per unit. So that's the first step that I like to do, visualize the situation. Let's now do part A together. What is the maximum price that divisional manager F would accept for the special chemical? Well, first thing we'll do, let's find that selling price, which is $1,000. So we have price $1,000. And we have a cost of further processing, don't we? I'll call that further processing cost, abbreviated, just to save a little space here on my screen. What's left over, people? $800. So we could call that the net revenue earned, right? We charge $1,000. We've got to pay $200 further processing. So the difference there, $800. Now, what's the maximum price that F would theoretically accept? Well, if we set the price at $800 for that variable cost, that other chemical, then the profit would be zero, right? So at $800, divisional manager is breaking even, not making a loss, but also not making a profit. So guys, that's the theoretical maximum price. Let's now calculate the minimum price that divisional manager I would accept. Well, divisional manager I has to cover their basic cost, right? So the minimum would be that variable cost of $500. Now, imagine if I was also selling to the outside world for $600 and we have limited capacity. I can only produce a set amount of chemical. Now, look at that. There's a difference, a contribution, a selling price of $600, a variable cost of $500. So now there's a contribution here of $100. In this situation, Divisional Manager I would also say, wait a second, if I'm going to forego my external sale, you have to make me whole. You have to cover that missing $100. That would be known as the opportunity cost. $100. So in this situation, the minimum price would be $600. But guys, I just made all of that up. That's not in our little scenario, isn't it? Right? There is no external buyer. So the opportunity cost in our scenario is 0, and then the minimum is really $500. So ladies and gentlemen, we've just done part A and part B. We've calculated the maximum that F would accept and the minimum that I would accept for selling. Now, let's comment on the performance evaluation issues if the transfer prices were set at $500 and $800. Oh, funny that. Look, the minimum and the maximum. So let's just draw let's sketch that again. So we've got the divisional manager from I. We've got the divisional manager from F. If we set the price at $500, that's the bare minimum that I would accept. If we set the transfer price at $800, that's the maximum that F would accept. However, as we discussed earlier, at $500, Mr. I is making no profit on that sale. He's only covering his cost. At $800, Mr. F is making no profit on the sale, only covering their costs. So either the maximum or the minimum transfer price, that would distort the performance of each of their divisions, and it would also demotivate them. And they wouldn't think it was fair, would they? They wouldn't think it was fair that the other manager gets all the glory. So guys, could you recommend a transfer price that both managers would accept, would lead to group profits being maximized as well as divisional profits being maximized? Well, I think you could. The difference there is 300, isn't it? So guys, right in the middle, if we set the transfer price at $650, Mr. I would say, that's awesome. I'm making incremental contribution now of $150. Of course, that goes to profits. So I'm $150 richer from that. Mr. F is going to say the same thing. Wow, I'm now making $150 on my external sale of my final product. So we're both happy. We'll both say yes to the transaction, and the group will also be maximizing their profits. Ladies and gentlemen, there you have it. How to recommend a transfer price that promotes autonomous decision-making, fair assessment, and maximization of the group profits.